All right, guys, what's going on? Good afternoon. Happy Sunday. It is, God, what time is it? It is 4:12 Eastern Standard Time here on a Sunday. Golly, I can't even remember what time it is anymore. I have to get used to this military time. That's how I used to use it. Reading the tape, everything was always the 24-hour clock. But I mean, I still got to get used to it, especially with the Bloomberg terminal. Enough about that. Well, I'm glad that you're here, guys, because we have a lot to get over. I didn't do an aftermarket recap on Friday. I was just absolutely drained after that week. The week was great. Very proud of everybody, but it's time to get back to work. Let's do it. G.A.R Capital. My name is Carlos Garcia. I'm the founder and CEO. Let's get started. A couple things that's on my mind, and I've been seeing this a lot in regards to everyone saying, "Is the bottom in? The bottom, the bottom, the bottom. It's over, right? It's over, Carlos. We got it. We got it." Keep in mind, guys, we talked about this last week, and it's the same thing I'm going to keep driving on to everybody. You can have a bottom, but not the ultimate bottom. Right? There's a big difference. Again, you can have a short-term bottom. We saw it. We saw that with the downward channel of the S&P, which I'm about to show you. And of course, you have an ultimate bottom where, okay, that's it. We're not going to get there anymore, right? That's what we call bottom. We had the same thing in 2300 on S&P back in 2020, and the same level back in 2018. 2018 being more correlated to what we are going through now in terms of Fed rate hikes. In that kind of environment, 2020 is a COVID lockdown. So I don't think it's a good idea to compare both environments here. But the thing that I did notice, guys, is it is kind of feeling a little bottomish, but there's a couple of things I want you guys to get a pen, write this down, and this is really important. We have a couple of pillars in terms of economics, in terms of macro. Some of the things that kind of hold up an economy in the United States uh, because how big they are, how important they are. So, one of the large pillars in terms of economics is unemployment or employment. People got to work in order to make money, right? And then you need money to buy things, to do things, or to invest in things. Kind of the same thing, right? We buy stuff, do stuff, invest in stuff. That's money. That's really all we do it for. So, how do people get access to money? Well, you have to work unless you also own some assets. You're a realtor. I mean, you're a landlord or you own stocks, stuff like that. Again, you still have to, in a sense, have to get capital. And right now in this economy, we can all agree, based on the numbers being at a sub 4% unemployment number, that the labor market is strong. Sometimes it could be too strong. Now that's interesting, right? What too strong? How can you have too strong of a labor market, Carlos? Well, when you have more people working, right, and you can't find people to fill your positions if you're a business owner, you have to increase wages. When you increase wages, what happens? Inflation goes higher. That's the normal textbook of how things happen. And if we have the flip side where no one is working, again, no one's hiring. And if you do need to find somebody in that position and unemployment's high, the labor pool is larger. I can lower the wages because I know somebody needs a job. And what is that? That's deflationary, back and forth. So it is the boring science for a reason because it's very, very, how do we call this? Goldilocks. It's not too hot, not too cold. Where we are right now, it's too hot. Inflationary is too hot. Again, inflation is hot because of supply shortage, because of too many dollars chasing too few goods. And then we have the issues in Ukraine and Russia. You try that all together with a little bit of sprinkle of COVID in China, and you got what we got. And again, the only real analogy that we can have here, that I've been saying it, is really around 1982. That's kind of the closest we can get. We had high energy prices. We had high interest rates due to a very hawkish Fed Chair Paul Volcker. I suggest everyone research that time in our lives here in the United States. Well, I was born in 85, either way. High interest rates, you had high energy costs, you had Russia in Afghanistan at that time. Sound familiar? And if you really want to go a little deeper, a new older president who beat an incumbent. Ronald Reagan came in 1980, beating Jimmy Carter, who was an incumbent at the time. Joe Biden beating Donald Trump in 2020. That's the incumbent. Now, again, that could be all just coincidence, or we live in a simulation. Who knows? But we're going to go ahead and play like that. Again, history is our friend, is going to teach us a couple of things. So we're talking about the pillars. We have very high employment, strong employment. That's a strong pillar for the economy to hold. So a lot of people say recession. You can't have a recession when employment is this strong. You just can't. Yeah, people working still. Once you start laying off, and we have seen some layoffs, some big names, and there's some names that are hiring that we don't hear about. Adobe being another one, which had a pretty decent quarter in terms of guidance. But again, they are hiring, and we saw that Tesla, meaning anything that Tesla does as a headline, as we know, but they are laying off some staff. JP Morgan is, I guess, rearranging some people or laying off mortgages. That makes sense when you have higher interest rates and higher home values. Just like anything else, it overheats. It overheats and then it needs to cool off. So that's why you're getting more layoffs in the mortgage sector, which is very consumer sensitive, especially in a time where the consumer doesn't feel as confident. We just got those University of Michigan consumer sentiment readings at 50, the lowest we've ever had, pretty much lower than 2008, lower than the dot-com bubble, lower than COVID, lower than 1982, 1981. That's where we are. We're in a place where confidence is not high, and that's fine. Again, as traders, we have to see the entire view of the market. So that's one pillar. We have the employment. And then I kind of went through the path of layoffs, right? Now we're talking about homes, home values. Very important. How important is real estate to our economy? When you buy a home, right away you're paying construction workers, engineers, realtors, all those people. And again, when you buy a home, you need to buy furniture, you need to buy appliances, you want to repaint the house, you want to buy electronics, you want to buy the basic simple things such as a towels, excuse me, utensils, placemats, you need some chairs, you need all this stuff. And then if you have a backyard, you want to do stuff to the backyard. It doesn't stop at closing, guys. It adds more. I'm a homeowner. I know this for a fact because it's not just buying like even a car. It's like buying a car. Well, I have everything inside. I don't need any accessories. Everything in your home becomes an accessory where, you have that guest room and you want to add a TV in there, but then you want to buy a console for it. You want to buy a entertainment center. That's a pillar. That real estate is so important to our economy. Now that real estate is strong, I think we can all agree. Again, new home sales beat expectations. That's a strong pillar. We're going to add that on there. So that's one and two. We have strong employment. We have strong housing still, strong home values. People are buying homes. They're not subprime or anything. I think it's very, very regulated. I could tell you firsthand how regulated the mortgage market is. That thing is a pain in the ass to apply for a mortgage and to close, guys. Take it from me. Anyone here who bought a home the last 2 years can understand what I'm talking about. Closing is not just 10 minutes of signing something, it's hours. You're signing a lot of things, and you got to give a lot of paperwork. Your income docs. It's not just blank anymore. This isn't the Big Short, guys. Housing is strong. It's very regulated now. So we got the two pillars. Let's go one more pillar. What is the other pillar? It is corporate earnings and corporate profits. If corporate profits are still strong, employment will be strong. And if employment is strong, then housing will be strong. If housing is strong, corporate earnings will be strong. It goes in a circle or a triangle, if you will. That's your three pillars of an economy. And right now, we can say, just from the outside looking in, it's still strong. Now, the asset market, the stock market, the bond market, commodities, some commodities are down, but for the whole of the market, asset prices are down. This is what the Fed wanted. This is what they wanted to do. They wanted to lower prices. That includes stocks. Now you see where I'm getting at. Again, nice bounce, but it's follow the Fed. The Fed is telling you what to do. The Fed is saying, hey, we want lower prices. They don't give a crap about your portfolio. They don't care about your assets. This is why we had a sell-off. Now you throw in the inflation for the reason why the Fed is doing what they're doing. High inflation, that's their main mandate. They can't go drill more oil. They can't go ahead and fix up supply chains. They can't stop the war in Russia and Ukraine. That's the Fed. So what can they do? All they can do is raise interest rates, make it difficult for you to obtain money. But again, if you're, and the Fed's idea is, well, everyone's already employed. We have a strong labor market. We need to cool that down. This is a way to do it. And then the labor market will cool the housing market because housing prices are very high relative to just 3 years ago. Interest rates are high. Let's cool that down. And then what's the next shoe to drop, guys? It's corporate earnings. That's a lot to explain, and I hope you guys wrote this down. So we got the first two, the corporate earnings. This is why I don't think we're at a bottom yet. A lot of people are saying Carl's bottom, right? It's over. Not yet. We do have a very, very important July coming for us, guys. Very, very important. This July is very crucial. Why do I say that? Because we get corporate earnings again. We need to see two things: how they did last quarter and their guidance. If they are bad and we get lower guidance, the good news, that's pretty much the last shoe to drop, if anything, but it's not gonna be pretty. We're gonna retest those lows. So again, corporate balance sheets, if they are not strong, beating expectations, if we're still seeing growth, that is amazing. Then we may talk about a soft landing when it comes to what we're going through of raising rates. And again, some of the Fed is talking about being a little more dovish. Dovish meaning that they may not do as much rate hikes. That's the best we're going to get. With that being said, okay, a couple of things I want to share with you guys. Let me get my phone because I had a list of stuff. Very, very important. First thing, let's go ahead and bring up the S&P 500 chart. Here's the same chart that we've been showing before, the downward trend, right? Very, very important to take a look at this downward trend. And we talked about the two gap fills to fill, 3,600 being, or 3,660 being that support of that downtrend. Again, you could see it did tap it, but it didn't break it. Now, again, you can always kind of move this trend line over to kind of go for the wicks. That's fine too. But either way, the channel's the same. So we had a gap up. We filled this gap here right around 3,900. We're now above it. And again, I just moved the arrow above. If you guys have watched us on Instagram and TikTok and Twitter, we've talked about this. 4,000 is our gap fill level. Technically speaking, right around 40, let's just call it 1% away. But 4,000 being our target, really what we want to know is, are we going to reject or break? Technically speaking, that's all we're looking at. Are we going to reject or are we going to go higher? If we go higher to 4,200, the reason we will get there is because corporate earnings were strong. Or inflation comes down in the next CPI report. If it's already working, the Fed's going to back off. If they see at least some headway in inflation readings, the Fed is going to back off. They don't want the world to end either. They don't want asset prices to tank either. They want balance. They don't want pure crazy speculation, dot-com bubble, and they don't want nobody ever getting in the market ever again. We don't want 1932 or 1929, excuse me, the Great Depression, the Great Crash. Here's an interesting article I want to go over with you guys. And I follow, obviously I have the Bloomberg, but I want to show you on the website. JP Morgan's quant. This is one of the best rated quant analysts ever. Okay, so let's keep in mind he's not just some perma bull like some people call me, which is okay. Marco Colonovic, steadfast bull on the U.S. equities during this year's sell-off, is calling for a 7% rise next week as pension and sovereign wealth funds rebalance their portfolios. We talked about that last month when we had the rebuying or repurchasing, rebalancing of portfolios. So again, if in a given month, if stocks fall too much and bonds go a little too high, remember they have a 60-40, 60% equities, 40% fixed income or bonds. That's why we talk about bonds a lot, and then you just have to even it out. So what does that mean? More equity buying in order to offset the gain in bond value if it's not there, and so on and so forth. You still want that 60-40 sweet spot. So again, he's expecting a 7% rise in equities. So if we're right now at 39.11, let's go ahead and do the calculation. Here we go. So we'll do 7% of, what is this, 39.11? That's 273 points. I'm lazy. That's 273 more points. That's 4173 on the S&P. He's expecting a 7% rise, I believe, what, this week? This whole week. So where does that get us? Let's go back to our chart here. 4123 would get us to right around this midpoint here. Now, again, is that very possible? Of course it's possible. And I'll show you how we've done it already. And it was a fake out. So be careful. So again, I'm all about the making sure the rebalance and everything. But the EPS revisions, that's what we want to look for. Again, just having the balances is not part of the three pillars. What are the three pillars? Corporate earnings, corporate profits, got housing, and we got employment. not rebalancing of pensions. That's not a pillar. We're not going to hang our hat on that in terms of investing. In terms of trading, why not? But we have a technical reason to get to 4,000. So in a sense, I do agree with Mr. Kolanovic that we are going to go higher. We are going to go higher this week. Again, especially ahead of a holiday week. July 4th being next Monday, no market open. I highly expect us to rally to 4,000 from where we are now, possibly even breaking it, but not too much. Last time we broke above that, you could see we were right at 45.11 and the breakout level was 44.17 and we still came down. You can still have wicks above, no problem. It's not fixed. It's not a, remember when you have a resistance, it's not solid board. You can't break it. Of course you can. Just like support being just like a mattress, it can sink into support. You can sink into it. So now we have this chart. Let's go ahead and take a look at this here. We're going to go ahead and zoom out year to date on the S&P. And let me see if I can get this going. This is this year. I'm looking for the March break. Here we go. So March, we had a nice base. It seemed like 4,200 was support. I thought that would be the support, but we did not get that as we fell further down. So it was a fake out. You have that 4,200, and then we had a nice break all the way to 4,600, 400 points. Where did we come from? 3,600. If we get 400 more points, that'll get us to 4,000. So again, let's measure the moves now. This is key. So S&P, and I apologize that I'm doing just these kind of bars, but you could see from peak to trough, 12% move. 12% move, peak to trough to the upside from the base of support of 41.13 in March. And remember that March, that nice rise. Okay, so let's complete this here from the 36.65 level. Where's it going to get us with 12%? 12 point. If we're just going to match that bear market rally, where would that put us? Right there, 4,100. So just only 100 points more do we need to match, 200 more points to match what we had that last rally. So let's make this even better for this exercise. When is it a point that you think we've bottomed, Carlos? Now we're talking. Let's go over it. I say 4,200. Why do I say 4,200? Okay, we stopped right here on that channel, no problem. We got the 12% that we wanted. That's 4,100. But crossing 4,200 right here, not only that gives us clearance higher than any clearance that we've broken above this channel to kind of suspect that we were in a bear market rally. This will clear above it. That would clear above it, and then 4,000 becomes your base, or 4,000 becomes your support. Guess this: the apex of this channel will now become your new support. That's how that works. So again, 4,200. If we get above that, to me, I would be comfortable to say that's the bottom of the stock market. And stock market is thinking ahead of the total general economy itself. Keep in mind, we were pricing in a recession months ago, and then now people are just talking about recession. It's different. Again, what is a recession? 2 consecutive quarters of GDP being negative. We're not there yet. Employment is still too strong. Housing is still too strong. Corporate balance sheets, we'll see. But again, does it have some bottoming formation? Could be. Start to look at it, but I will not be comfortable to make any kind of decision until we start breaking above 4,000. That's it. Because we could just reject here again. So we keep this in mind. Let's go ahead and put it to 4,000. And that's just a 10% measured move to the upside. Okay, when can we go by that again? Well, right over here is about 8. That's from this, again, just retesting the trend. Remember, we broke down below it, and then we got back to it. So that's about, what, 8%? 8% little market rally. How about this one right here, where we hit this bottom here, and we got to this apex here, or this level here. This was just May. Remember that end of May rally? Remember that end of May rally where we had rebalancing? We talked about it. Check the tape, guys. 9.41%. What are we starting to notice? As we fall down the channel, we need to regain just a little more just to get back to par. If you're in golf, for example, get us back to that trend line. So you have the 8% measure move that we had mid-March, which was the bull market or the bear trap, right? Or the bull trap, excuse me. And then we kind of just hovered down. You could see just downward trend in April. We came down to test this trending line here, or excuse me, this channel. We went ahead and retested that low. That's a 9% measure move to the apex or the top part of that channel. That's 9%, slightly 1% higher than the 8% move. We come down, we have two gap downs. Now we measure the bottom 3666 to that apex that I expect us to get to 4,000. That's a 10% move. It's taking more and more and more. This does not tell us that the worst is over. We have to break 4,000 until you, and to be completely honest, 4,200. I would say 4,200, guys, that would confirm the worst is over. That's it. And that's fine. I would start getting into riskier assets if that's the case, because now we're starting to see the momentum. That's a bigger measured move than we had just recently. Again, you get to 4,200, you're talking about 15% off the bottom. And there's no other time this year where we've bounced that high at all. We've had an 8, we've had a 9, and not even yet, we've had maybe a 7. So again, there's still a lot to go. We need to find that third pillar. Again, that corporate earnings. I do expect us to go higher. Don't get me wrong. I do expect us to get to 4,000 this week. I would be focused on the beaten down names. So now we're going to go and start looking at what's next. What are we going to look at together? All right, we went over the measured stuff. We're good. So let's take a look here at some of the names that have been beaten down. We'll go ahead and go to just the group screener. Very easy. We'll keep it very simple, S&P. So let's do in terms of 1 year relative performance. This is every sector of the S&P year to date. So year to date, again, starting Jan 1 to now. What has been the weakest? Technology, okay? Tech, cyclicals, okay? And communication services. All you need to go is for the 3. If we're bullish, let's be bullish the ones that have been hit the most, because we know they're going to revert back to the mean. And I talked about energy stocks being too hot, overbought on many time periods. I would still wait for energy to get down to around 90 to 85 before I start dipping my toe into energy. It gets rotated out, and it gets rotated out very quickly. Check 2008 if you know what I'm talking about. So we know the three charts, 3 sectors. We have technology, consumer cyclical, and communication services. Let's go to the maps. What are some of these names? Technology. Okay, so let's go ahead and zoom. Let's see here. This is too small. Let's zoom this a little bit. Bear with me a second, guys. Let me zoom this out for me being blind. Much better. Okay, so technology. Right off the rip, I can name you a couple of names that we've traded many times and always has a great volume, great names to trade. Apple, we know the drill. Microsoft, we know the drill. Both are great. Traded them last week, made bank. Nvidia, the semiconductors have been taking a hit lately. Keep in mind. So Nvidia, I like. AMD, watch out for. Qualcomm has some good moves. Intel, not as much. AMD, and so AMD, Qualcomm, Micro, and Nvidia, those are the 4 I like to trade the most. Intel is worth a shot too. Again, we're just looking for weakness. We're just looking for relative weakness for the year. And then we start making a list. So you can add Apple to this list. You can add Microsoft to this list. You can add Nvidia, MU, Qualcomm, AMD. Right off the rip, we got what? 6 names that we could start researching now. Communication services. Well, Google's going to do their split pretty soon. So we'll keep that feather in our cap till July 15th. I think that's when they're doing it. Meta. Meta has been absolutely beaten to the woodshed. Meta is worth a shot. Disney, beaten by the woodshed. Worth a shot. They're worth communication services. Netflix, taken out to the woodshed. Verizon, AT&T, not so much. I don't trade them as much. EA or ATVI, no. I want something with high volume. So again, Netflix does, Google does, Meta does, Disney sometimes. Not all the time. Cyclicals, that was the third one, right? Amazon, you could trade Amazon now. It's cheaper. Tesla, always has volume, guys. GM has volume sometimes. Ford has volume all the time. Nike, the spread's a little wide. Home Depot does have some good trading opportunities. Starbucks sometimes. McDonald's sometimes. So again, cyclicals, communication services, technology. Keep it in the S&P 500. Keep it simple, and that's what we're going to do. So again, Microsoft, Apple, all those names. Now, let's go ahead and compare together. I'll do some charting here. Let's go and take a look at Apple. You're saying to yourself, well, Carlos, why would I want to buy as we're moving higher? And I agree 100%. We have some gaps to fill. There's one right here, guys, to 138.28. So I expect this to pull back as we open relatively soon, as I'm recording this video for futures. So again, could we get a pullback on some of the headlines from Russia and the gold ban from the EU or the G7, excuse me? Yeah, we could. Does it mean that the complete trend has changed? No. I still think we're going to go higher this week, 4,000. So with that being said, Apple runs pretty close to the S&P. I just think we gap fill to 138.13 eventually. Hopefully we do, so then we can go ahead and play the bounce depending on market movement. But really, take a look at the daily here. Let's go over some moving averages. The 20-day moving average is an interesting one. I really like to look at it the daily because it tells me a lot. There is still a gap to fill at 142.65. Would I run out in the market and go buy today? Not as of yet. I have to see how futures open. But again, wait it out. Time is your friend. So again, above the 20. Same thing with Microsoft. Above the 20, now tapping the 50. How about Meta? Near the 20. It has a gap to fill. So I like Meta a little more here than I do Apple. 175.24. Take a look at this on the daily. And right below the 20, we still haven't broken any kind of meaningful trends, but it is interesting. 175.24. I'd probably target those names. Amazon got a double bottom here. Amazon does have a nice gap to fill to the upside. So we're going to keep that in our back pocket. I want to see if we break 125, possibly 128. That's your wick high just the past 5 days. If it does, I definitely want to start hitting the 135 calls. Take a look at Tesla. Again, we know the thesis. We know that we're expecting to go higher. So again, we're going to keep the same kind of sector breakdown. We're going to go technology, we're going to go communication services, and we're going to go with consumer discretionary. Again, these are all beaten down names this year. We saw the breakdown. So we're above the 20-day on Tesla, still within a range, kind of. You got up to 791 before you do anything. So really, if you're looking at Tesla to break out, since it's so expensive, you kind of have to go out of the money here. I like to target 800 for Tesla as we go higher, 700 being that Fibonacci level that I had. I don't know if that's still intact. Probably not, because that was the low. So again, I'd have to redo this Fibonacci level. Let's go ahead and edit it. Actually, let me go ahead and cancel this. Let's remove the drawing. We'll go ahead and add the percentage symbol, which is Fibonacci retracement. We'll top the bottom all the way down here to 625. So we did break the 50 on the weekly, or stayed above it. And on the hourly chart, as long as we stay above 630, you got 770 as a target. There is a gap to fill at 780. What do we need to do to get there? Get above this right here, guys. 754. I probably would just bite the bullet and go for the 800 calls on Tesla, especially if we have a risk-on environment where Bitcoin is up, aggressive growth. We know the aggressive growth names, guys, the high betas. Those things move, Tesla's going to move, barring some headline, as we know. There's always headlines with Elon Musk. So let's go ahead and wrap this up here. I know I talked a lot. Let's take a look at the week that we have. We have the G7 meetings that's been going on today. I'm not watching, but kind of keeping up to date with Bloomberg here. We got pending home sales at 10 a.m. Important. That's the pillar. We had good new home sales numbers, so I expect pending home sales to be a little less, obviously, in terms of what we are used to. They're saying a forecast of negative 0.35%. I wouldn't be surprised if possibly that's positive. Crude oil inventories, that's going to be 3 days. Interesting. Wow, we had crude oil inventories for 3 days. G7 meetings go for day 3. We also have good trades balance. I really don't pay attention to that. We also have FOMC member speaking. A lot of the Fed members are talking. GDP numbers, very important, because if we go quarter over quarter GDP number, what does that mean? If we have a red reading on the GDP, not a good sign. That's your first negative GDP number for the quarter. That's the last one that we just had. So again, if that's red, not good. Fed Chair Powell speaking on Wednesday the 29th. And then we also have core PCE month over month, and then ISM manufacturing PMI. Ahead of a big holiday like July 4th, we'll have non-farm payroll. We're going to have FOMC meeting minutes. So a ton of stuff coming up ahead, and that's going to be a short week anyway. So Yeah, a full plate. Let's say this week. We need to get to work ahead of the holidays so we can just relax. But the main thing that stands out here out of everything is definitely that GDP number and Fed Chair Powell speaking. Now he's going to speak not in front of Congress. He's gonna be in a panel discussion that's titled Policy Panel at the ECB Forum and Central Banking in Portugal. So let me go ahead and leave you with this: the S&P again. I don't want you guys to get too excited as of yet. If this is the bottom, I'll be the first one, guys. Be the first one to celebrate with you. But 4,000 is the key. I think we get there this week. I think you stay long until 4,000 because this might be just a bull trap. Hope you guys enjoyed the video. Have a great rest of your Sunday. We'll catch you guys tomorrow for the morning note. Cheers.